IBM saying Cyber Monday sales as of noon were up 20% over last year. Market research firm Comscore says spending today could reach $1.2 billion. We're going to get some perspective now. Craig Johnson is right here. He is the president of Customer Growth Partners. It is a retail consulting and research firm. Thanks so much for coming in. We're very glad to have you here, Craig. Thanks.
Glad to be here.
Now, you are an outlier. You've done research pre-holiday season for a long time. You said it was going to be stronger, and you are right. So why were you right when others were not?
Well, all the other forecasters out there said this year was going to be up 2.5 to 3%, which is fine. We have a top-down as well as bottoms-up survey that, and methodology we use. And the numbers, when you added them all up, came up to 6.5%. We issued this in October, and the numbers so far, November is mostly over, and it looks like, we're on target. Black Friday weekend was up about 10%. Now, Black Friday weekend is virtually always stronger on a year-over-year basis than either early in November, which is relatively slow, and early December. We think we were right primarily because other folks overlooked key factors. One, the consumer is much healthier than people think. The 91% of people with jobs, who account for 97% of spending, is much healthier. Disposable income growth is decent, if not superb. The savings rates have normalized from peaking pre-recession, 8.2%. They're normalizing over the last 3 years down to about 4%, which is long-term normal. And households are much healthier from a financial point of view, the household budget. The Fed puts out something called the household debt service ratio that peaked going into the recession at 14%. That is gradually winnowed down as consumers deleverage to 11%. That's the lowest it's been since 1994. So on a balance sheet basis, household finances are actually the healthiest they've been in 17 years.
Which is really surprising because, even if you read the papers, it is all doom and gloom.
Nobody pays attention to this, except those of us who, look at the arcana of the numbers. And so when you drill down to the actual numbers, people are actually much healthier. Their credit is actually down. Consumer credit's down about 18% from the peak earlier in the recession, where people were all over leveraged and drawing on their home equity lines. They've refied their houses. They're drawing down debt, and they're actually much healthier. So when they spend at this 6.5% year-over-year pace, they're not spending by charging up the plastic. They're spending out of current cash flow, which is a much healthier way to spend.
That is a healthier way, and actually it's kind of nice to hear the perspective. Craig, congratulations on your correct forecast. Craig Johnson joining us there. Customer Growth Partners, a retail consulting and research firm.